Today's market did not move on the news. It moved before the news. A trader turned a $60 million Micron options bet into $1.5 billion in profit. Iran published the framework of a peace deal, but oil markets had already priced out the risk last week. Ken Griffin says AI is making him depressed about elite finance jobs. 3 Fed insiders flipped today and called for rate hikes, first time in 3 years. And Robinhood just opened the door to AI agents trading real brokerage accounts. The pattern is obvious. By the time the headline reaches you, the trade may already be over. This is the signal. Let's get into it. Today we are tracking 6 signals. An 8-week-old options bet that paid 25 to 1. The Iran deal framework and the vanishing oil risk premium. Ken Griffin's warning on AI and finance jobs. The sudden return of rate hike talk. Robinhood's agentic trading launch. And the defensive sector setup nobody wants to touch. For 3 months, markets were guessing what a US-Iran deal might look like. Today, Iran put the terms on the table. Iranian state media published the framework for a US-Iran Memorandum of Understanding. The key ideas. US military forces withdraw from the vicinity of Iran. The US Navy lifts the Hormuz blockade, and a 60-day window to finalize the broader deal. Iran says nothing happens without, quote, tangible verification. Secretary Rubio says negotiators still need several more days on the wording. So the deal is not signed, but markets are already trading like the worst case is fading. Hormuz is not just a headline. It is one of the most important oil choke points in the world. About 20% of global oil and 20% of global LNG passes through it. When Hormuz risk rises, oil gets a fear premium. When that risk falls, the premium disappears fast. Gasoline futures already dropped 5% to a 5-week low. The S&P closed at a record. And the US Navy is already escorting a Greek supertanker, 2 million barrels of crude, through Hormuz today. The deal is functionally live. The only loud bear left is Piper Sandler. They say Hormuz stays closed for months and oil hits new highs. If they are right, this is the trade of the year inverted. The number, 60 days. If the framework survives that window, oil loses its biggest geopolitical catalyst. Watch for polymarket odds on ceasefire holding 60 days. If they cross 70%, oil is done as a story. Now to the wildest market story of the day. On March 31st, somebody placed a $60 million bet that Micron stock would explode upward. The trade was a call option. Basically the right to buy Micron at a fixed price by mid-June. 8 weeks later, today, that bet is worth $1.5 billion. 25 to 1 return in 58 days. The question is not whether they got lucky. The question is what they knew. Last Thursday, ahead of the 3-day Memorial Day close, Trump said, quote, Micron is great. They could invest over $100 billion in New York. Today, markets reopened. Micron surged 19%, added $160 billion in market cap in a single session. This is the most explicit Trump quote to market move in history. Either it is the largest insider trade in years, or somebody read the political and AI infrastructure landscape with stunning accuracy. We do not know yet, and that distinction matters. A smart bet is legal, a leaked bet is not. But either way, the lesson for investors is the same. The market had already positioned before the public quote hit. Micron is not just a chip stock anymore. It is being treated as part of the AI infrastructure stack. Memory, data centers, domestic manufacturing, and political capital, all in one trade. UBS just tripled its price target to $16.25, implying $1.8 trillion in market cap. The number, 60 million to $1.5 billion, 25 times return in 58 days. Watch for whether Samsung gets the same UBS treatment this week. If yes, the whole memory complex re-rates together. Ken Griffin runs Citadel, one of the largest hedge funds on earth. He is worth over $40 billion. He is one of the smartest capital allocators alive. And this week he used one word to describe what AI is doing to elite finance. Depressed. Griffin told Yahoo Finance that agentic AI is automating the most high-skilled jobs in his industry. Work that used to take PhDs months now happens in hours. The realization, in his words, left him, quote, depressed. Same week, U.S. credit card delinquencies hit 13.1%, the highest since 2011. Meta filed a warn notice to lay off 1,400 more employees in King County in July. When Ken Griffin tells the press he is depressed, that is not a feeling, that is a leak. Citadel is one of the most aggressive capital allocators on earth. If he is publicly worried, his firm is already redeploying internally. The trade is no longer AI versus labor. It is which firms operate first without the PhDs. The number to watch, assets under management per employee at the top hedge funds. If firms like Citadel grow AUM while headcount stays flat or falls, the rest of finance copies the model in 12 months. The signal, AI is moving from productivity tool to organizational redesign. Finance is the first industry where we will see it clearly. For 2 years, the only Fed question was when they cut rates. Today, 3 of the most powerful voices in finance flipped the question. Citadel Securities publicly said the Fed should move closer to raising rates, citing rising oil, AI-driven growth, firm hiring, and persistent inflation. Former New York Fed President Bill Dudley said the Fed risks losing credibility after years of missing the 2% target, and that long-term expectations may become unanchored. Minneapolis Fed President Kashkari said a prolonged Iran war could spur a series of U.S. rate hikes. Only Bank of Montreal is still arguing for cuts. When Citadel, Dudley, and Kashkari converge in one day, that is not noise. The market is dismissing it because equities are at records, but defensives are at record lows. History says when the Fed has to choose between fighting inflation and protecting risk assets, inflation wins. If CPI comes in soft, the market keeps drifting higher. But if CPI comes in hot, the rate hike conversation goes from fringe to mainstream overnight. The number, 3-to-1. The ratio of insiders calling for hikes versus cuts in a single trading day. Watch for core CPI on June 12th. Above 3.1%, July hike odds jump from 11 to 40. This may be the most important retail market story of the year. You can now hand your entire brokerage account to an AI. Robinhood announced today that customers can delegate investing and credit card spending to AI agents. Users connect Anthropic's Claude or Cursor to a dedicated Robinhood account. 5 clicks from a Claude conversation to a live stock order. The AI agent trades and spends on the user's behalf. And the SEC has not said one word. Most market rules were written for humans. A human reads research. A human clicks buy. A human is responsible. But what happens when an AI agent makes hundreds of decisions, reacts instantly, and has direct brokerage rails? Who is responsible? The user? The AI company? The broker? The developer who built the agent? Front-running rules assumed a human. Pattern day trader rules assumed a human. Wash sale rules assumed a human. None of that contemplated an LLM with a brokerage API token. Either the SEC rewrites the rulebook by Labor Day, or every retail edge gets arbitraged by agents in weeks. The number, 5 clicks. Claude conversation to a live brokerage order. Watch for the first SEC statement or enforcement action involving AI agent trading. That sets the tone for the whole space. Now to the setup nobody wants to talk about. Utilities, staples, healthcare, the defensives. They have been left behind while AI and megacap tech carried the index. That makes sense when growth is strong and investors want upside, but it created a dangerous imbalance. The utilities sector relative to the S&P 500 has fallen to a record low ratio of 0.06, down 40% since the 2022 bear market. Meanwhile, the S&P's net profit margin excluding financials hit a record 15%. Net margin excluding the Magnificent Seven and tech is down to 8%, the lowest since the 2020 pandemic. So we now have two markets stacked inside one index. The AI winners are priced like monopolies. The defensives are priced like nobody needs safety anymore. That usually does not last forever. Rotation does not require a crash. It only requires investors to ask one question. What is cheap, hated, and still producing cash flow? That is where defensives come back into the conversation. The number, 0.06. Utilities to S&P at an all-time low. Watch for the first defensive name with a positive analyst surprise. That print starts the rotation. Here is what every story today has in common. The public headline is late. Iran publishes peace terms, but energy traders were already moving. Trump praises Micron, but the options trade was placed 8 weeks earlier. Ken Griffin warns about AI, but Citadel's internal restructuring is probably already happening. Fed voices talk about hikes, but the market is still priced for cuts. Robinhood ships AI traders, and the rulebook has not caught up. Defensives are ignored, but the setup is building quietly. That is the market now. It does not wait for the official announcement. It moves on positioning, probability, and who sees the signal first. The lesson is not to chase every headline. The lesson is to ask 3 questions every morning. What had to happen before this headline became public? Who was already positioned? And what does the market still refuse to price? That is where the edge is. Subscribe to The Signal. Every weekday at 6 p.m. Eastern, we break down the stories that matter before they become obvious. Tomorrow, we are watching 3 things: polymarket odds on the Iran ceasefire, the next memory chip analyst upgrade, and any SEC statement on AI agent trading. 3 signals, 1 trade. I'm Marcus Webb. This is The Signal. See you tomorrow.